Rachel Reeves has been accused of coming for your family's future with a possible inheritance tax raid, but a former Treasury advisor has warned the change is still one to be enough to fill the £50 billion black hole. Officials are thought to be looking at scrapping the 7-year rule, which means that no tax is due on any gifts you give if you live for 7 years after giving them, to help address the UK's multi-billion-pound shortfall left by Labour U-turned higher borrowing and sluggish economic growth. It comes just days after the National Institute of Economic and Social Research, NIESR, piled pressure on the Chancellor to come up with solutions ahead of her budget in the autumn. But Jonathan Portes, a former Treasury advisor and professor of economics and public policy at King's College London, who supports the idea of inheritance tax reform, told The Independent such changes would certainly not raise tens of billions of pounds or anything like it. Tory Shadow Chancellor Sir Mel Stride accused Labour of punishing working families to fund their failure, while leading analysts at Hargreaves Lansdowne warned Labour may come to regret making detailed changes to inheritance tax, as it could hamper efforts to boost economic growth. Inheritance tax is paid when a person's estate is worth more than £325,000 when they die, and is seen by many as a form of wealth tax in all but name. Under current UK rules, gifts made more than 7 years before a person's death are exempt from inheritance tax. Money given less than 3 years before is taxed at the full inheritance tax rate of 40%, while gifts given between 7 and 3 years have a taper relief tax between 8 and 32%, while it is understood that no decisions have yet been taken. Among the reported measures under consideration is a potential lifetime cap on gifts to limit the amount of money people can donate outside of inheritance tax, as well as reviewing rules around the taper rate, sources told The Guardian. Responding to the reports, Mr. Portes said, "Inheritance tax certainly needs reform. It is too easy for very rich people with good tax advice to avoid, and it is welcome HMTHM Treasury is looking at this. More broadly, we need to tax relatively well-off older people more, whether during their lifetimes and on death. However, HMT reform will certainly not raise tens of billions, or anything like it." Hitting out at the prospective measures, Sir Mel said Labour is coming for your family's future to fund their failure. Those who worked hard, saved responsibly, and hoped to leave something behind shouldn't he be punished to pay for Labour's economic black hole. He added, tax experts have also raised the alarm over the possible changes, with the government planning to levy inheritance tax on pensions from April 2027. Scott Gallagher, of wealth management firm Rowley Turton, warned that families with 2 children and an estate over £1 million could be leaving more money to the Chancellor than to either of their children. The more children you have, the worse it looks. I recently told one client that, on his death, each of his 4 children would get just 15% of his pension, while the Chancellor would take 40%, he said. Meanwhile, Rob Mansfield, an independent financial advisor at Roots Wealth Management, said it could put people off from saving into their pensions. It's a double whammy if you're over the age of 75, as not only could you pay inheritance tax on the pension at 40%, but the beneficiaries would then pay tax on any withdrawals at their marginal rates. We need people to save more into their pensions, and taxing people for doing the right thing seems perverse. Former Chancellor and businessman Nadhim Zahawi also took aim at the idea, telling The Independent it could cause more wealthy individuals to leave the UK. He urged the Treasury to make further spending cuts rather than hiking taxes. If the Chancellor wants a surefire way to endanger Britain's finances further, raising inheritance tax would be top of the list, he said. As a businessman, I know that top talent is leaving or staying away because they don't want their life's work stolen by a greedy government that won to wean itself off an addiction to wasting taxpayers' money through excessive spending. Meanwhile, Sarah Coles, head of personal finance at Hargreaves Lansdowne, said reforms would need to be balanced against the fact that, at the moment, these gifts allow for money to pass through the generations, something which brings in taxes such as stamp duty and VAT when the money is spent. They also feed more money into the economy and boost economic activity, she said. warning that a change in the rules could stymie this flow of cash, which could have an impact on growth. An Treasury spokesperson said, as set out in the plan for change, the best way to strengthen public finances is by growing the economy, which is our focus. Changes to tax and spend policy are not the only ways of doing this. As seen with our planning reforms, which are expected to grow the economy by £6.8 billion and cut borrowing by £3.4 billion. We are committed to keeping taxes for working people as low as possible, which is why at last autumn's budget we protected working people's payslips and kept our promise not to raise the basic higher or additional rates of income tax employee national insurance or VAT.